Hello again, this is HT, the head trader for Leading Edge Trading. You can find us at leadingedgetrading.com. Our topic today is why trade the ES. We get a lot of questions, people asking us why do we trade the S&P instead of the NASDAQ or the Russell or something else, whatever it is they prefer. We swing trade a lot of other markets, but the whole world focuses on the S&P market. 100 years ago, when there were only 100, 120 publicly traded entities in the world, two guys, Charles Dow and Ed Jones, created the Dow Jones Industrial Average. Their concept was to use the top 30 stocks out of those 100, 120 to create an index by which the market sentiment could be measured. If your stock was outperforming the index, that would be good. If it were underperforming the index, that would be bad. Well, there are a lot of companies that deal in market-related data, Reuters, Bloomberg, Standard & Poor's, to name a few. Well, Standard & Poor's came up with the idea of using 500 stocks, which makes a whole lot more sense when you've got 8,000 plus stocks or 40,000 plus if you consider the pink sheets as well. So the S&P has become the arbiter, really, of what is true market sentiment. For that reason, whenever you're trading, usually you need to monitor where the S&P market is and its strength or weakness. For example, you wouldn't look to short weak stock candidates if the S&P is strong. Conversely, you wouldn't look for stock candidates for buys if the S&P were plunging. So if you're going to follow the S&P anyway, you might as well trade it. And here's why. Number one, it runs the world. The S&P market really is the dominant force on a global market basis. If the S&P market is up today, if you look at the European and Asian markets, they will most likely follow suit. And conversely, if the S&P is weak, they will be also. Number two, it's very logical. When we're talking about risk, we want a logical market. I hear frequently from traders who ask, why don't trade the NASDAQ? Why not trade the Russell? It moves like a race car. Well, it moves like a race car with no steering wheel. Granted, there may be some range and volatility, but if you can't trade it with quantifiable risk ahead of time, it's just gambling. And in my opinion, if you're going to trade size, which is what big traders strive to do, you want a logical market. Number three, big money is not the enemy. Big money is what makes the market logical. Big money stabilizes the price structure. It's what makes it stop at the points we post in our room. It's what makes us achieve the targets that we post in our room. That's big money driving the bus. So you hear a lot of times we want a level playing field. Unless you've got $500 billion you can play with trading, you're not going to create a level playing field on your own. That's a myth. But the preposition for that, where big money is the enemy, is the fact that you're fighting against big money. That would be impossible. Big money is not the enemy. We want big money. Have you ever heard the expression, I'd rather have a smart enemy than a stupid ally? Couldn't be more true in this case. Big money adds stability and logic to the market, allowing you to predetermine risk and keep that risk small. Number four, timing and price. That is what gives the market logic in terms of structure. We can time it plus or minus a couple minutes in terms of when something needs to hold or when something should be tested price-wise for a break or a target, etc. You can't do that in an illogical market. Number five, leverage. Your broker can set day trade margin. Usually they're particularly reasonable for a $6,000 contract. Day trade margin is typically $500 or less. I've seen it go as low as $200 or $100. Maintenance margin is set by the exchange, but your broker can set day trade margin. Makes it incredibly cost advantageous to trade this market. The commissions are typically lower than they are on stock trades. And number seven, you get good daily range, 10 points or more. Typically, we get 2-3 times the daily range in our daily trading of the S&P market. Liquid, it is probably 2 million contracts on average, 1.5 million to 2 million a day. On a quieter market, 4 million plus. On a busy news day, there's plenty of liquidity. So that means there's very little to no slippage. We use limit orders, so we're giving up a quarter of a point at the most. Tax advantages, I'm not an accountant or an attorney, so I can't tell you what they are particularly, but I would suggest you consult with your tax professionals and you realize trading the S&P, because it's traded as a commodity, has greater tax advantages than trading equities. Number 10, accuracy equals small risk. And that's what we strive for. That's what all traders should strive for. Not being right, being accurate. When you're accurate, you can limit the risk. Let's take a look at a typical day here in the SPY. It doesn't matter what day. We're going to use an apples-to-apples comparison of the SPY, popularly traded vehicle, especially for stock traders that are following the S&P. They're just using the wrong instrument. So let's take a day. Just picked one arbitrarily. We made this some time ago. February 22nd, 2011, in the top left corner, where we depicted the entire range. It's a down day, so we would say if you were selling at the high and buying at the low, and I hear the moans already, oh, that's impossible. It's not impossible. We do it all the time. But as I said just a moment ago, we typically capture more than the entire day's range. So if we're going to use an apples-to-apples comparison, we have to have some rigid parameters. So if we're capturing more than the day's range, then we could say using the exact day's range in an apples-to-apples comparison is fair game. So just bear with me here. So if we captured the entire day's range, this February 22nd, 2011, sold at the high and bought it back at the low, we would have captured the entire range of 3.09 on the day. Let's look at that same day in the S&P E-mini futures contract. Same day, upper left-hand corner, February 22nd, 2011. If we sold at the high and bought at the low, capturing the entire day's range, that would have been 32.25 points. Now, that's only relevant if we understand what they pay per point per unit traded. So let's look at that. If we look at the SPY, in the bottom right-hand corner, we mapped out an example. And let's say you risked $2,500. That is not to say you have a $2,500 account. You might have a $25,000 account. You may have a $1 million account. But you're only putting to risk $2,500. If we were going to sell the SPY at the beginning of the day when it was trading 134.56, or at the high of the day, I should say, then that $2,500 would only let us control 18 units at 134.56 times 18. If we captured the entire move down on the day and bought it back at the low, we would have captured 309 per unit controlled, or a profit of $55.62. 309 times 18. However, if we put that exact same $2,500 to work in the E-mini S&P futures contracts, these are traded electronically, but they're traded through the Chicago Mercantile Exchange, where they trade futures contracts. It has nothing to do with the future, has nothing to do with the contract. It's just a name. They could call them banana options. It wouldn't matter. The best part about this is no matter where we begin our participation, our margin is the same, unlike a stock. If a stock is trading at $8 and you want to buy 1,000 shares, you have to put $8,000 to work. If that same stock is trading at $80 a share and you want to buy 1,000, it's going to cost you $80,000. This market, it's the same contract margin price wherever your starting point is. Obviously, plus or minus from there is your value in terms of your payout. The S&P E-mini futures contract pays out at the rate of $50 per point and is graduated into quarter-point increments. In other words, $12.50 a tick, $25 for a half a point, but in essence, $50 per point. So if you caught this entire move, selling at the high and buying at the low, you would have captured 32.25 points. If you multiply that by $50 per point, for each contract traded, it would have yielded $1,612.50. But you traded 5 contracts because it only cost you $500 per contract to control each one. Multiply that by 5, that is $8,062.50. Now you tell me, would you rather put $2,500 to work and make $55.62? Or would you rather put $2,500 to work and make $8,000? $62.50. It's obviously quite simple. Now, it would be easy to say, is that realistic? Of course it is. With our guidance and what we post, we would have captured more than the day's range. So I don't want anyone to get visions of sugar plums dancing in their head, but I'm quite capable of mapping the day out and telling you where the market's going. In fact, we do that every day. If you go to our site, right below the Try Our Free Live Chat Room Now button, you can see what we did last trading session. Those are renewed at the end of each day by a moderator in our rooms, in two of our rooms. Moderator B, for example, on that day we captured 26 points, and it wasn't even a big range day. Here's another day earlier this year, March 2014, captured 25 points. Those are posted every day, so you're welcome to go see for yourself without any obligation, without us even knowing that you went to check. Just go to leadingedgetrading.com, see what we did last trading session. If you're interested in knowing more, we welcome you to join us in our free live chat room where we post specific entries, exits, direction, timing, etc. in advance. This is HT from leadingedgetrading.com. We'll see you next time. Thank you.